Welcome back, folks. As you may have already learned, the Federal Reserve held its meeting on September 19th and the 20th and decided to keep the interest rates unchanged. I'll go over the mechanics of their decision and what it means for the buyers and sellers in the real estate market. But first, let's listen in to what Jerome Powell had to say on the September meeting at the end of that meeting.
Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks.
In recapping, since early last year, the Federal Reserve has significantly tightened the money supply by raising the interest rate by 5.25 percentage points and has continued to reduce their securities holdings at a brisk pace. So what are securities holdings of the Federal Reserve? Federal Reserve buys and sells securities such as treasury bills, treasury bonds, etc. to the large bank. This is a tool that the Federal Reserve uses to control, to shrink or expand the money supply in the economy. So when Fed buys these securities from large banks, it increases the money supply to the banks, who then in turn lend that money to the consumers like you and I. When Fed sells or reduces their securities holdings, the Fed sells the securities to the large banks, which in turn shrinks the money supply in the economy, thus slowing the economy as the Fed is attempting to do these days. Let me show you a chart that will give us a better insight about this. You can see from this graph, Fed's actions in the past few months have brought inflation under somewhat of a control, but a lot remains to be done because the Fed's goal is to achieve and sustain a 2% inflation. They have covered a lot of ground, and the full effects of their tightening have yet to be felt. So as you look at this inflation chart going back to 2022, we can see that the headline inflation has come down, but it can very quickly rebound if people feel that it is okay to start spending money again. One measure of calculating if the Fed monetary policy has had any impact on the economy is to look at the consumer credit trends in the revolving versus non-revolving credit categories. Here's a quick snapshot of consumer credit trends over the past 12 months. As you look at this chart, the first question you're going to ask yourself is, what is revolving versus non-revolving credit? Revolving credit is any kind of credit that you can continuously dip into if you need more funds, like a credit card or a line of credit. On the contrary, the non-revolving credit is some credit that is forwarded to you as a one large sum payment, like a home mortgage loan. So as the data shows, revolving credit, like credit cards, peaked in 2022 and as of July 2023 has partially subsided. On the same lines, non-revolving credit, like home mortgage loans, have also slowed down by July 2023 after reaching its peak levels back in 2022. One of the major factors considered by Federal Reserve in deciding whether to raise interest rates or not is the monthly Consumer Price Index report, commonly known as the CPI report. Let me show you a snapshot of it. CPI report for August reported that the headline inflation for August was at 3.7%. That is up from 3.2% in July. However, core inflation, which excludes food and energy prices, is actually 4.3%. So that is an improvement from 4.7% in July. So let's start with the highlights of the CPI inflation report. We're going to cover energy prices, food prices, shelter, as well as services. So let's start with energy. As you can see from the chart, the prices are down 3.6% year over year. So energy prices fell year over year. However, from July to August, month over month, energy prices went up 5.6%. Gasoline prices alone have increased 10.6% in 1 month alone. So year over year, lower energy prices tend to help to lower the overall inflation numbers. But moving forward, energy prices are expected to worsen the overall inflation numbers. Now moving on to food prices. It's being reported that the price of food is up 4.3% year over year. For example, fish is up 0.1%, coffee up 0.9%, fruits and veggies 2.1%, meat's up 6%, bread's up 6.3%. Moving on to shelter year over year. The cost of shelter is up 7.3%, but you have to understand that there's a big lag effect with shelter inflation, the CPI report. That's because shelter inflation in the reports takes into consideration pre-existing contracts. So shelter inflation is slower to rise up, but it's also slower to fall down. You could think of it as more of a smoother process compared to the real prices that we are seeing in the real world. So keep that in mind. However, ultimately, 7.3% obviously is a big jump and is going to be a gradual decline. That's what you're going to see in the reports in the next few months if the economy evolves as the Fed hopes. And finally, services inflation. So services inflation is being reported at 5.9%. This is a minor improvement from July when it was at 6.1%. So the most likely scenario going forward, what the Fed predicts, if the economy evolves as projected, the appropriate level of the Fed funds rate will be 5.6% at the end of this year, which is 2023, 5.1% at the end of 2024, and 3.9% at the end of 2025. And finally, almost achieving the magical number of around 2% inflation by 2026. So for the buyers and sellers out there, if you can afford to buy a house, buy it now before the next Federal Reserve meeting on October 31st. Given the fact that the Federal Reserve did not raise interest rates in September, they are sure to raise interest rates at their October 31st meeting. If you are selling your house, you should be cognizant of the fact that when Federal Reserve raises interest rates on October 31st, you will have a much smaller pool of buyers who would qualify for the high interest rate mortgage rate, which will reduce your chances of selling your house then. So sell it now before the rates go up. I hope you found the material in this video helpful. Please like, share, subscribe, and we'll soon return with some more information for you. Thank you. Have a blessed day.